Berger, and I've known this man for quite some time, broken bread with his family. Actually was at his house when they had some elves show up to read Llama Llama Red Pajama at Christmas time one year, which was a treat. I was looking for a picture of that, I couldn't find it. But Serge and I have become great friends over the years. I've helped him with his business and watched him evolve into an amazing trainer for the trading and investing community. And so I'm going to go ahead and give him the microphone for 1 hour. Serge, go ahead and mic up and let's see if we can see your screen.
Hey guys, can you hear me?
Loud and clear.
Lovely. Let's see if we can get the screen to work too.
Are you in Switzerland right now?
I'm in Zurich. Yep.
What's the sentiment over there with the COVID?
It's fine. Things have opened back up, so it's pretty good.
Y'all are open back up, like 100%?
No, not 100%, like 50, and they open up more stuff every day. So.
Okay.
Are you nervous about that and staying home, or are you like going out in it?
Well, I've been working from the office most of it, actually all the time, because my office is just a few blocks away from the house, so I just walk down to the office.
Yeah, but you're not going to like hang out in the club. That's what you're saying?
No.
Okay, I got you. All right, Serge, you have 1 hour. The mic is yours. Thank you for being here.
Cool. Thank you, guys. I appreciate you guys putting on the event. As Jeanette and Bali said, I mean, this is certainly a one hell of a time in the markets, and I think it's only appropriate to start off the conversation today with a little bit about kind of where we think things are in the market. Hope that's okay with you guys, kind of going through that, and then we'll show you how we are approaching this market and what we think is sort of what makes the most sense here from a strategy perspective. I'm just quickly bring up the little Q&A thing so I can see those questions as they come in. Just give me 1 second. But I have actually one question before we get started, folks. How many of you, type in yes if you are interested in creating, if one of your goals is to generate income or a positive return from the stock market, from your portfolio on, say, a month-over-month or quarter-over-quarter basis, type in yes and be honest about that if that's one of your goals. I'm not saying that's your entire goal, but if that's one of your goals, type in a yes into the chat box or whichever box we're operating with here. Yeah. Okay. So, and this is important because I'm going to come back to this. So a lot of you guys are typing in yes, which quite frankly is, so all of you that are typing in yes are probably being honest. And isn't that everyone's goal? Yes and no. Some people just like to increase their account over time. Not everyone's goal, not 100% of people's goal consciously is that's what they're trying to do, but I think subconsciously it is most people's goal, right? So do I speak French? No, I don't speak French. I have a whole, if there's enough time, I'll tell you guys a story why when I tried to speak French and I went to JP Morgan and we lost, I think $5 million because I traded the wrong side because I was trying to speak French for a trade. We'll talk about that a little bit later. But let's quickly go through the market and then we'll get back to this question about income. What we think as a house is that, you know, if you look back over the past 90 years, the S&P has returned about 10% per annum. But over the past 10 years, so the 90-year average is about 10%, but over the past 10 years, the S&P has returned about almost 14%. So we've almost had a 50% higher return in the S&P over the past 10 years. And what happens is when you bring forward those returns like that, you tend to have a very different decade going forward. So we think we've entered into a much different decade. There's a plethora of reasons for that, and I'll get to that in a second. But just from a return perspective, I think if you have gotten used to seeing your accounts grow by 10% or a 10x of that, right? If you're maybe been more active, I think a lot of people have to really dial back their expectations and looking more for like a 4 to 5% per annum return in the S&P 500. So we'll get back to that also in a few minutes. There's a couple of major structural problems that are happening right now in the market. And this is aside from the economy, right? We know we have negative growth. We know we have basically no inflation. We know we have a lot of monetary debasing, i.e. quote unquote money printing. But there's a few other problems that I would at least like to highlight you for some perspective. And you can let me know if this is at least helpful for some perspective. But one big problem that's happening is that the era of stock buybacks, corporate buybacks, is essentially coming to an end. And if you look at this chart that I brought along here, you look at that blue chart, This is U.S. corporate buybacks over the past decade. And you can see that they've taken the lion's share of basically stock buying over the past 10 years. So if it wouldn't have been for companies buying back their own stock, I can guarantee you the S&P wouldn't have had nearly the run it had, right? So in addition to that, what you're having is pensioners, maybe baby boomers, and well, not maybe, definitely baby boomers and others in that sort of age group above and below there, they are de-risking their portfolio. So maybe if you're a baby boomer, you can kind of get your own head around this. You're probably looking to, over time, de-risk your portfolio. So you're going to probably buy less equities going forward. So there's two major problems with the structural bid we've seen in equities, not just for the past 10 years, but really for the past 40 years. And that is, I think, a structural problem that's really now coming home to roost. If you look at stock buybacks in a different way, you can see that over the past 2 years, so 2018 and 19, the stock buybacks, actually, there was more stock buybacks than capital expenditures, like investments that company made in their own companies. So there was more basically buying back stock, and quote unquote, this is not my words, but the media will say that it's been enriching the CEOs as opposed to investing in the companies. And I think that's a major problem. The second major problem is that of dividends. You're seeing a lot of companies, basically a record amount of companies, canceling or suspending dividends. That is also getting that bid in the stock market, making that bid even more difficult. And those are really the two major problems. Now, how did we get here? I think this is really important to understand. So what I did here is I took a chart of 3 different asset classes. The blue line is the S&P 500. The yellow line is gold, or the GLD ETF. And then you have the green line, which is treasuries, treasury bonds. And if you go back to the summer of 2019, you'll see that we had a period where that bid started to really come in, both in gold and the bond market, and also the bid in the equity market continued. And that then became even more crazy towards the end of the year, late December 2019, where gold and treasuries really started to rally and the equity market ended up holding up. Now, as you can see, what happened due to the second half February, first half March fallout in equities corrected sharply. That's the blue line. But look at those other 2 lines. That's gold and treasuries. And you guys can probably see that they never really lost their bid, right? I mean, there was some setback for sure in the near term due to liquidation and and things like that. But for the most part, these 2 asset classes are right back at their highs or even higher, right? And so this is a structural underpinning in the market that we're seeing on the institutional side, that people are continuing to buy gold and treasuries, among other things, but the equity market has kind of lost its bid. So the smarter money tends to be parked somewhere in the fixed income market. So you probably want to take that cue from that. If you look at something like the Russell 2000, this is a long-term monthly chart. So each one of these bars is 1 month. You can see that unlike gold and treasuries, equities, if you look at them through the lens of small caps, all they're doing is bouncing back to what basically is broken resistance. This is just a very simple technical way of looking at it. On the other hand, gold, as we said, is really breaking out nicely. This is a long-term monthly chart. Again, basically breaking out of an inverse head and shoulders pattern, if you want to be technical about it. Gold miners are acting very well as well. In fact, they're pumping even higher today right now, up about almost 2.7% on the GDX. But there are other problems out there as well. And this is a chart that I do. We do a lot of ratio charts for our clients. And this is a chart that took the Nasdaq 100, divided it by the New York Stock Exchange Composite. Why would you do something like that? You would do something like that so you can see how highly concentrated the Nasdaq 100 is. And you can see that dramatic relative outperformance of the Nasdaq 100, which, just so you guys know, 50% of that is just a few stocks, Microsoft, Apple, those kind of names. And you can see we've broken above the highs of the year 2000 internet bubble. So we're having a massive amount of market concentration in just a few stocks. If you look at this in terms of the S&P 500, what I did here is I took an S&P 500 equal weight index. So if you weight every single stock in the S&P 500 equally, so if Apple has an equal weight as a smaller stock, and you divide that by the actual S&P 500. I know this might be a bit of a mind twist, but what this chart is telling us is that just those very few stocks, the Apples, Googles, Amazons of the world, they are carrying all the weight. So if it wasn't for the S&P having a few heavyweights in there, the index would be doing much, much, much worse. And lastly, what I wanted to look at here is giving you some perspective in terms of recovery times. You hear a lot of people talk about V-shaped recovery, stock market goes back to all-time highs tomorrow and all that kind of stuff. Here are some facts. Now, it could always be different, right? So we don't know this for sure, but just so you guys have some perspective. If you look at the 1980s crash, 87 crash, 2000 crash, 2008 crash, all of those took 2+ years to recover, and they all had a 28+% drawdown. Now, the year 2012 crash, I mixed that in there because that's actually not even really a crash, but just for perspective, that was a very different part in the time in the economy. So I would argue that based on just this alone, we are probably going to have a much longer road back to sustainable all-time highs in the equity market. So that's just one of the things I wanted to show you guys. So give me a quick yes if you're following me so far. But was this helpful just for a little bit of perspective? I wanted to make sure you guys can get you head around a little bit kind of how we function, and we're going to go into the strategy. So what I'm trying to tell you is that we're probably going to have a lot more volatility going forward, and I think the easy buy the dip and let it ride on a 50-day moving average is probably over for an expanded period of time, and you're going to need a strategy that is going to make you much less sensitive to having to be directionally correct and or correct in timing. And I will show you exactly what that means here right now. Just so you guys know me, this is my mug. I originally come from a bit more of the institutional side of things. I was an investment banker at JP Morgan, then moved on to family offices and hedge funds. And for the past 11 years, I have my own company now doing a lot of the advisory and money management that we do. So what I'm about to show you is a strategy that I have used my entire life, done for huge accounts, smaller accounts. We teach it to everyone. We do it for everyone. This is what our solution is to trading a market, any market really, quite frankly, but particularly when it gets a little bit more choppy, as we think it's going to remain for a while. So here is an interesting statistic. So a lot of you before said or admitted that you would be looking for a more steady return on your investments, right? In other words, you'd be looking for a positive month-over-month or quarter-over-quarter return, right? So in order to do that, though, you need to understand a couple of facts. First of all, I took a 12-month period of the S&P 500, and you can see over this 12-month period, the S&P had big up months, big down months, and anything in between. Now, you guys would probably agree that if you're looking for a more steady month-over-month, quarter-over-quarter positive return, is this kind of a return distribution going to work for you? It's all over the place, right? That's not going to work. Now, the problem is that a lot of strategies, in fact, I would vouch most strategies, and I used to work in the fund-to-fund business as well, where we analyze strategies, are very closely linked to the performance of the S&P 500. Right? And so you don't want this. So the strategy I'm about to show you, first of all, you can make a lot of money with it, as you can see, but much more important is a much steadier stream of positive returns, as you can see. And by the way, this is the S&P 500 performance broken down by month over month over the past, whatever I put here, 12, 14 months. So if you would have bought stocks or the S&P in April of last year, you would have round tripped. That wouldn't have been much fun. So your whole goal of month-over-month, quarter-over-quarter performance would have been out the window. So we need a better solution to this. So a lot of people's return streams look something like this mountain range here, where you make a little bit of money, you give it up again, you make some money, give it up again, and you're basically trotting sideways, right? And that's very frustrating. Not only is it frustrating because you're not making money, it's very frustrating because you're working and then you're seeing no results after some time. And for a lot of people, that is basically how they operate for a very long period of time. So what I've come to realize after being in this business after 22 years, I've done this strategy for 18 years, is that people need some sort of a positive month-over-month or quarter-over-quarter return. Why? Just to be able to stay in the game psychologically. So I want you to think about this. close your eyes and think about this. What if someone gave you, you know, 3,000, 4,000, 5,000, 10,000 bucks at the end of the month, regardless of how you did in the market that month? Wouldn't you agree? Wouldn't you agree that you would be more prone to stick to your game plan? You'd be less giddy to jump after trades. You'd be more relaxed in general, right? And quite frankly, you'll see you'd probably make a lot more money, right? So this is really, really important. It's really important that we get you in the right frame of mind. And I think most people cannot be in the right frame of mind unless they have some sort of positive return that's very steady. And by the way, it doesn't really matter whether you're, 20 years old at a job or 40 years old or you're retired or soon to be retired. This is a perfect strategy you can deploy because it doesn't require a lot of time. So if we take this a step further, what we've noticed that stagnating or losing accounts is going to not only lead to a loss of confidence that you have in your strategy that you're deploying, but also in yourself. And that's just completely unacceptable, which in turn leads to breaking rules and forcing trades. And before you know it, you're essentially gambling, right? And that's a really big problem. So what I'm about to show you here, this approach of looking at the market, it's going to do three things. First of all, it's much less stress. Number two, it's very high probability. And thirdly, this is the most important part, it's very, very repeatable. And I'll show you guys this here right now in 1 second. And the time requirement is about an hour per week. And we're looking at trades that are roughly 80% of the time they're profitable. So out of 10 trades, you should have 8 profitable ones. And the 1 or 2 that are losers, they are not going to wipe out all the gains of those past 8 trades, which is what most people do, however, right? So we need to make sure we don't do that. And this strategy will ensure that doesn't happen. Now, at the very core of this strategy lies this whole phenomena of when steep slopes go vertical. I'm sure a lot of you have seen this kind of a thing, right? Where you have a steep rally and it goes vertical. And this happens in all time frames, by the way. Second, you can also have this happening on the downside as well, right? So you can have a steep drop that basically goes vertical on the downside. And at some point, things get extremely oversold, right? They get so oversold that there's going to be some sort of a mean reversion. So when steep slopes go vertical, then implied volatility or the pricing or the expensiveness of options becomes more elevated. Investor fear or greed reaches extremes, and the reward to risk for what I'm going to call a counter trend trade become absolutely amazing. So I want to walk through a couple of options selling statistics. Before we go through that, though, because I'm going to break down a big myth. How many people in here have ever traded an option before? Type in me if you've traded an option before. I'm just curious how many people have traded options before. Okay, so if you've traded an option before, so a lot of you have. Some people have, some people haven't. Perfect. It doesn't really matter whether you have or not. My point is the following. I'm going to go through some statistics right now. And these statistics that I'm about to go through, they are correct. However, unless you do this the proper way, these option selling statistics are not only completely false, they're completely useless. And it makes this whole thing very dangerous unless you understand the truth. So a lot of people will tell you that the odds are strongly in favor of the option seller, which basically means if you are going to buy an option, you hold it to expiration, you technically only have a 25% chance of making money. So if you, vice versa, were to be a seller of options, you technically would have a 75% chance of making money if you held it to expiration. Makes logical sense, right? The problem is, unless you do this correctly, this statistic is not only completely useless, it's actually very dangerous. And then a lot of people will talk about this thing called theta, time decay. Anyone ever heard of time decay, where you have to sell an option and hold it to expiration? It's actually very, very dangerous. And I'll show you guys, and I'll prove it to you here in just a minute. So this is a big, big no-no, at least in our land of wanting to have a more steady stream of positive returns. So here are the 4 steps that we're going to walk through together. And you guys can write these down if you want to, maybe take a picture with your phone, whatever you prefer. These are the 4 steps we're going to walk through, and this is our process. The first thing we're going to do, we're going to look for very steep slopes, so very steep rallies, and looking for signs of exhaustion. Then we're going to make sure that the implied volatility is at least somewhat elevated. And then we're going to make sure that the options liquidity is very good. You don't want to trade anything that doesn't have good liquidity. And then very specifically, what we're going to be doing is we're going to be selling far out of the money call or put spreads that expire about 2 or more months out. However, and this is a really, really big deal, and I'll share this in a minute, there's something very specific that we do. And if you're sitting here right now and you're saying, oh, I've done this before, I can guarantee you almost 98% certainty what I'm going to show you, you've probably never done before. How do I know that? Because we can see what's being taught and we can see what the retail community does, and they do the exact opposite of what we're about to show you. And then what we're going to do is we're going to rinse and repeat this on a monthly basis so we can really create that income machine for you. So again, at the very core of the strategy lies this concept of a steep slope that goes vertical. You can see it here in Alcoa. The stock went vertical, well, it went a steep rally and then went vertical, and then it became exhausted. It stopped going higher for a period of time. Or here in Netflix, you can see very steep rally, it goes vertical, and then at some point, it becomes exhausted and it stops going higher. So these are the points in the market that we're looking for. And so when slopes go vertical, then the upside becomes very limited or capped, and the same thing happens if the move to the downside becomes vertical, right? So for example, just look at mid-March in the broader market. What happened? The market went completely vertical to the downside, and at some point it was just so oversold that it could simply no longer go down. And I'll touch more on this in a minute, right? And then what happens is that you tend to actually get a very sharp mean reversion move. So we'll talk about this and I'll show you exactly how this works. So over the next few slides, what we are going to do is we are going to look at a few historical examples so I can teach you how the strategy works. Okay, so the next few slides are historical examples so I can teach you how it works. Once we've gone through those, we are then going to go into the live market, and I'm going to ask you guys to type in some ticker symbols as well so we can actually look at this and you can see that I'm not just making stuff up. But here's a chart of Facebook. And you can see that over this period of time, Facebook had a very steep move to the upside within these two parallel lines. But then it had these few like vertical moves here and here and here. And who can tell me what happened every single time the stock went from the steep rally into vertical? Yes, it mean reverted back into the uptrend channel, but much more importantly, and this is the first point where we're going to try to really get this you're in the right frame of mind, it stopped going higher. Repeat that after me. It stopped going higher. So let's have a look at Facebook, and I'm actually going to bring over my chart here. Let me just 1 second. I have to go back over to my chart, which is, I believe it's over here. All right. So we're going to look at this example right now, and we are going to have a look at this through the lens of what it means to put on a high probability trade. So here's the actual charting platform. Oops, keep going back and forth. Good times. And what I'm going to look at here is a point in time where the stock once again went vertical to the upper end of its channel. So this is the same exact chart I showed you a second ago, but here you can see it on the actual live chart. And so the point in time that we're going to focus on here is this point in time here where the stock, once again from its steep long-term uptrend, once again went vertical and reached the upper end of its trend. Now, when the stock gets up here, what are some of the things you could do? Well, if you owned the stock, you could maybe sell it, take some profits. If you want to be a little bit more aggressive, you could probably short the stock, right? You could buy a put. But who can tell me what is the one thing that the stock must do at this point in time if you're going to short it or you buy a put and you want to make money? Who can tell me that? What's the one thing the stock needs to do if you're going to short it or you buy a put? What has to happen to the stock? It has to go lower, right? If it doesn't go lower, you will not make money, correct? Well, let's think about what the stock could do at this point in time, as it could at any given point in time. Well, the stock certainly could go lower, but it could go sideways, right? Could it go higher? Of course it can. So the stock at this point in time, as at any point in time, can do one of three things, correct? Lower, sideways, higher. But if we short the stock or we buy a put, and it must go lower in order for us to make money, all else being equal, who can tell me what is the probability, what are the odds of us making money? All else being equal, it's 1/3. You have a 33.3% chance of making money. In the world that I come from, that is not a high probability trade. That is really more akin to gambling. So instead of making a bet on where we think the stock is likely going to go, we like to make bets on where we think it is most likely not going to go. So in this particular instance, what we did is we sold an option up there. We sold another option against it, a few dollars higher up here, which means that I am going to make money whether the stock goes lower, sideways, or the stock could even go 8% or so against me. I can be 100% butt naked wrong, and you could still make money. Okay? Now, there's much more to come. I need to go through this in more detail. But who would agree with me, just from what you've seen so far, that this is probably a little bit higher probability of a trade to put on than doing a directional trade, whether that's buying or selling? Type in yes if you agree. Again, there's more to come. I need to go into more detail. But who can see that? Okay? So now at this point, I always like to remind people, I like to remind you of the following. What is the one goal? What is the one goal that we have in this business? It's to turn a profit, correct? Is the one goal that we have to hit a home run on every single trade? No, it's not. If that's your goal, then you got to do something different. If you agree that your goal actually is to hit a positive return, you need to put yourself into a position where you actually have a truly high probability of turning a profit in any given trade you enter. So instead of making a directional bet where we have a 1/3 chance of making money, we like to make it a bet where you, in this case, if the stock goes lower, you make money. It goes sideways, you make money. It even goes against you to a degree, and you still make money. That means that more than 2 out of 3 scenarios, you are going to make money. Now, let me show you guys what we actually did here. So we did a trade in the past. Again, we're going to go into the real, into the actual market in just a few minutes. What we did is we sold an option expiring with the 125 strike. So we sold a call up here at the 125 strike at the time, and we bought against that for protection a 130 strike call. This on most broker platforms, and probably all broker platforms, this is a one-click deal, right? You have one click and you do that trade as a pair. In order to put on this trade, we didn't actually even pay anything. We received money. We received $1 or essentially $100 per options contract, or $1,000 deposited into our brokerage account with 10 options contracts. Well, in this example, a few days later, the stock did go lower, and I will show you guys trades in just a few minutes where that didn't happen and we made just as much money. And the spread was reduced down to 24 cents, which means we got to pocket the difference between 24 and $1, which is 76 cents, i.e. $76 per options contract, or $760 with 10 options contracts. But the crazy thing is, the stock didn't actually have to go lower for you to make money. It could have gone sideways. It could have gone against you. You could have still made money. All right? Now, this is where it's really, really important you guys pay attention. So if you're fiddling around on your phone or you're doing something else, please just pay attention. This is really, really, really important to understand, because this is what most people do wrong. So you guys can see that this trade was put on in the month of February at the time. Well, we did not sell February options. We didn't even use March options. We used options expiring in April. But the key thing here is that we only hold these trades on average for about 10 to 14 days, so about 1 to 2 weeks. And that's really, really important. And let me explain to you why that's so important. So let's assume for a minute that here at the time in February, instead of instead of using options expiring in April, we would have used options expiring in February. Let's also assume that the minute you put the trade on, this stock immediately rallied, let's say, 5% against you. Who can tell me what happens if to your P&L? Yeah, you basically take a punch right to your face. That's what happens, right? So even though I sold options way out here, because I'm using these short-dated options, I basically take it on the chin, right? So basically, I use the car analogy. If you have a car with 4 wheels, you just lost 3 wheels and you're done, right? You just toast. But what if here in February, you did as we did, we sold options expiring in April? What happens at the minute you put the trade on? What happens if the minute you put the trade on, the stock rallies 5% against you? Yes, you're going to lose some money, but using the car analogy, you might lose 1 wheel, right? You still have 3 wheels, push it back to the garage, you call AAA, whatever, and you're fine. In other words, you take a manageable loss, right? So instead of taking it to the kisser every single time the trade goes against you, you're taking manageable losses, you get out, and you move on to the next trade. But keep in mind, the trade can still make a lot of money in almost 3 directions that the stock goes to. Right. So this is a really, really big deal, and I hope this is making sense so far. So we're going to really hit this home now in a couple more examples. For example, here in Tesla is another example. So the stock had a very steep drop or had a vertical drop, I should say, after a steep decline. And this is the same chart that I showed you a second ago. And so what we did is we actually, instead of trying to buy the stock and trying to catch a falling knife and betting the stock goes higher, we simply made a bet that the stock isn't going to decline another 15 or I think maybe even 18% at the time we put the trade on, meaning we would have made money whether the stock went higher, sideways, or even 15, 18% against us to a degree, right? So what happened in this case, the stock did actually rally. We initially received $2,250 with 10 options contracts deposited into our brokerage account. A couple of weeks later, that spread was reduced down to 43 cents, which means we made $182 per options contracts or $1,820 with 10 options contracts. But again, keep in mind, the stock didn't actually have to go higher. You could have gone sideways or even against it to a good degree. Here's a trade we just had put on a few weeks ago. I figured I'd show you this on the S&P 500 because this is an index that a lot of people watch and follow. And what we did here is on March 16th, we sold what's called a bull put spread. On March 16th, I believe the S&P 500 was down already about 28%. And the bet we made was not that the S&P has to go higher. We simply said, we don't think it's going to drop another 18% over the next 2 weeks and stay down there, right? That's the bet we made. So the S&P did go against us a little bit, right? But by March 24th, the S&P was more or less back to where we put the trade on. We managed to close it for a profit of 11.4%. The S&P didn't even do anything. It more or less stayed from where we put the trade on, but we still made a profit of 11.4%. The S&P could have continued ripping against us. It could have gone higher, it could have gone sideways, and we'd still make money. Is this starting to make sense, folks? Give me a quick guess if this is starting to make sense. Yeah? Great. So one of the key things about all of this is to understand that a strategy like this, if you do it properly, the way I just explained it, is such a high probability strategy that it's really just a matter of cutting your losers when they go against you. And in this strategy, you can actually do that. Most strategies, when the trade goes against you, for the most part, it's already too late and you take a big loss, right? And that's a real big problem. So what I want to do, what I'd like to do, my mission is to really get you mindset to the point where you think about these credit spreads as your bread and butter strategy at the beginning of every month or week or quarter or however active you are. And you lay a base of those income trades, right? This is the first thing I do every single week, every single month. We look and focus on these income trades to generate that income for us so we can actually properly, live and breathe and think clearly. And then whether you do some day trading or swing trading, or maybe you have longer term stuff, by all means, you can do that as well. So we're going to go into the live charts here in a second, but I want to play a quick game here that's called Follow the Indicator. You guys can all see those blue arrows up here, right? Who can tell me what did the stock do to the right of the blue arrows? It went lower, correct? But really what it did is it stopped going higher. Agreed? It stopped going higher. How about here in Alphabet? What happened to the stock to the right of the blue arrows? Right? It stopped going higher, correct? For at least 1 or 2 weeks, the stock stopped going higher, correct? Or how about here in this ETF? What happened to the stock? Yeah, it ultimately went lower, or it's an ETF actually, but really it stopped going higher, right? And so this is how we find these points in time to actually put these trades on. So what I'm going to do, I'm going to go into the live market right now. And if you guys would like to, you can type in some ticker symbols into the chat box. And I'll just pull up the tickers and you can see, so you guys can see that we're not just making this up. Does that sound fair enough? So type in some ticker symbols and we're going to go over them right now together so you guys can see how this works. Yeah. Okay. So let's have a look at the first one. The question here comes from Jim, and he wants to look at BA. That's Boeing. Okay. So here's Boeing. This is just what you're asking for, right? And you can see the arrow here. So the last time the arrow printed was here. And what happened after the arrow stopped printing? The stock went a little bit lower, but then it basically went sideways. So what do? When that happens? When the arrow stops printing, you sell a put down here, you buy a protective put, you take in the income, you keep the trade on between 1 to 2 weeks, about 11 days, you close the trade, you keep the income, and you move on, right? This is what we do on a repeatable basis. Okay, great. How about Zoom? Sure, let's have a look at Zoom. This is a popular stock right now, I understand. Okay, so here's Zoom. And you can see the last time it had an error was here. What happened to the stock to the right of the arrow for the following 1 to 2 weeks, right? That's our time frame, 1 to 2 weeks. Well, the stock actually ended up dropping 30%, 30. So what do once the arrow stops printing on this day here? You sell a call, you buy a protective call, you take in the income, you keep it on for 1 or 2 weeks, and you move on. Can you guys see how this works? And it's very repeatable. You guys will see this as we go through some of these examples. GDX, sure. Let's have a look at GDX. This is gold minus. We're actually long GDX right now from another perspective, just in full disclosure. But here's GDX. I saw some people type that in a second ago. And the last time we had an error was here on the 13th of March. And well, since then, GDX is 77% higher. Okay, so what do you do at this point? Once the arrow stops printing, which it would have stopped printing on the 16th of March, you sell a put, you buy a protective put, you generate the income, you keep it on for 1 or 2 weeks, and you move on. I'm not making this up, guys. I'm just taking the tickers you guys are asking here. All right. How about oh, and I want to make sure we take ticker symbols that you guys actually know. Beyond Meat, BYND. Okay. Sure, I guess that's a popular name. So BYND. The last one was here. So you can see to the right of the arrow, what did the stock do? It stopped going higher. You sell a call, you buy a call, you keep the trade on for 1 to 2 weeks, generate the income, and you move on. Make sense? Okay. How about CVX? Sure, oil names. They have been in the news. CVX, this is Chevron. Last arrow was here. Okay, so this is Chevron. So the last time the arrow stopped printing was on the 18th of March. So you had a valid signal on the 19th of March. So what do you do on the 19th of March? You sell a put, you buy a protective put, generate the income, put it into your account, keep it on for 1 or 2 weeks, and you move on. And by the way, since then, GDX has rallied 73%. Not making it up. This is just what the indicator gives you. How about some more tickers, guys? Let me know what other tickers you want to go through. FedEx, sure. FedEx is here. Here's FedEx. The last time they had stop error is here. on the 12th of March. What do you do? Once the arrow stops printing, you sell a put, you buy a protective put against it, and then the stock basically, it went higher to sideways. So you keep it on 1 2 weeks, keep the income, and you move on. NVIDIA, sure. And let's look at NVIDIA. Let's have a look at NVIDIA. Absolutely. You bring that in. I have a different resolution on the other one of the other monitors here. That's why I have to keep going back and forth. Here is NVIDIA. And this is for you. And I'm purposely calling out your name so you know I'm not just making stuff up here. Here is NVIDIA. What happened to the right of the blue arrow? Well, yes, the stock did drop 35% or 40%, whatever, but it stopped going higher. That's the point, right? So we sell a call, we buy a protective call, we generate the income, and we move on. Who likes this so far? Can you guys see how this works? So what I'm trying to do is trying to show you what our process is for finding stuff and how the strategy actually works. Okay, cool. How about Lennar? Sure, that's a home builder name, right? So let's look at that. Lennar, last time it had a signal was also here. Okay, so Lennar had, so you can see it's printed for 3 days in a row, but only once it stops printing, in this case that would have been the 19th of March, do you have a signal. So 19th of March, what do? You sell a put, you buy a protective put, generate the income, and keep it on for 1 or 2 weeks. Happy days. By the way, since then, Lennar has rallied 76%. Just FYI. Okay. How about, is anyone here an intraday trader, as a day trader? I'm just curious because I can show you guys how the indicator works intraday as well. I do this on the daily charts, but if you like with the credit spreads, but if you want to use it for the indicator itself actually works intraday as well. If for those of you guys that care. Yeah. BJ's, sure. Let's have a look at BJ's. This is BJ, by the way. Let me just while you guys type in the intraday charts. Here's BJ's. It had an arrow stop printing on the 18th of March. And then the next day it stopped printing. So what do? You sell a call, you buy a protective call, generate the income, and move on. Intraday. Okay. What do you guys want to look at intraday? Let's have a look here. SPY, sure, SPY, that's always a popular one. So we'll do like, I don't know, like a 5-minute chart. Does that work? Okay. So here's a live chart of the S&P SPY, S&P 500 ETF. And the last time it printed was here overnight, 2 nights ago. And since then, the S&P 500 is higher by 3.8%. You could have sold a put spread. You could have sold a put and bought a put against it if you want to. I don't use credit spread intraday, but I want to show you that the indicator actually works intraday. Just that's the point here. Does that make sense? Okay. Nasdaq 100, same story. Nasdaq 100 gave us oversold signals as well overnight 2 nights ago here, and since then the Nasdaq is much higher. All right. How about Amazon? Sure. Today, let's see here. So this is Amazon. I don't know if it gave us signals. Here, it was actually it printed a signal right at the open. So right at the open this morning, Amazon gave us an overbought signal, and there you go. Tesla, sure. Let's have a look at Tesla. All right. Go back to the daily. All right, here's Tesla. I'm sure someone asked that before. I didn't see it though. The last time we got a signal in Tesla was here on the 4th of February. Oops. I'm not making it up, guys. Like this is actually what it printed, right? So what do you do at that point on the next day, on the 5th of February? You sell a call, buy a protective call, keep it on for 1 to 2 weeks, and you move on. Currencies, anyone do currencies? I think I saw someone type in a currency before. Let me see. Okay. Sterling dollar. Sterling dollar. Was there an overbought? No, we had an oversold signal here. Oversold signal here. And again, you could have sold a put, bought a protective put, and since then, sterling dollar has rallied like crazy. Euro dollar, sure. This is for Z, Eurodollar, Eurodollar, EUR, USD. Oops, Eurodollar here. Okay, here's Eurodollar. You can see it was overbought here, and it stopped printing on the 10th of March. So I guess you could have shorted if you wanted to. Intraday, I'm not a massive day trader, but I like to use 5-minute charts. So does this make sense to you guys? Helpful? Yes, no, maybe? Okay. So what I'd like to introduce you, you've seen that this is a process that works, right? So I want to introduce you to what's called the options income secrets, because that's why a lot of you here today is, because you said before, you're here to generate a more regular income from the markets, right? And what we're going to do is we're going to show you how regular traders like myself, that have done this on Wall Street and for a living, how we're able to keep producing positive results on a month-over-month and quarter-over-quarter basis again and again. And so what I'd like to do is like to introduce you to this options income secrets package. What are you going to get? You're going to get the monthly options income strategy that I just shown you here today, and that's going to help you produce regular income over and over again. And I'm going to give you that low stress, high probability cash flow income strategy. And the benefit is that it gives you steady and regular income into your account, meaning that now you don't have to second guess trades, and that every month that you have a reliable strategy to really put the odds in your favor and quite frankly, dollars into your account. Now with this package, you'll learn how to use options the ways the pros do. The benefit is that now you start trading with confidence, you start trading with a process, and it gets a little bit easier every day until it becomes essentially second nature. And I'm going to give you my cheat sheet as well, so you're not alone. Because trading is all about a process, and I really can't emphasize that enough. So when you follow a cheat sheet, it's there exactly for that, to follow a process. And also I want to give you an edge in the market, which is why I'm going to give you the indicator and the scanner. So that's not just about education, because I want you to have an edge in the market like all the pros do. And there's a reason why winning traders win like they do. It's not just based on knowledge, right? I think that's really a really important part. Now, there's actually a scanner that helps us scan for these things. I'll just quickly show you this. And the way it works is like this. So we have two scans, overbought and oversold, very simple. So for example, today we have this stock here that you can see is very oversold. It's coming up right now, and you can see the previous signal was here, and there's a signal right now that is probably going to get active maybe the next day or two, right? So that's as simple as it goes. Every single day you get the signals there, and you just execute on those signals. Now, we've made this very simple for you so that you can install this on Thinkorswim, on TradeStation, a NinjaTrader, and TradingView.com as well. So if you don't have any of these here, then you can use TradingView.com, which is a website you can go to and open up a free account, and you can install it there. So it's really very simple. We've really made that simple for you. But what makes the Vertical X Pro Indicator so great is that it gives you access to the highest probability credit spread income trading setups. I'm going to give you a platform and a foundation that whether you're new to trading or maybe you've done this for a while, that you have this strategy and you have this tool that you can rely on month over month, quarter over quarter, to just create regular income, because that's exactly what this does. And I showed you this here throughout the presentation, and I hope this is making sense to you guys. So the Options Income Secrets package, it consists of a course, ongoing webinars, and we even actually, and the indicator and scanner, of course, that I mentioned, and it also gives you an additional Iron Condor module that we added just recently. Here's some of the testimonials. You can see what people, it's turned into most people's bread and butter strategy, which is great, because it's literally changing the way that they're looking at the market. So that's been a real fun thing to see how people are finally starting to make sense of all this and actually put the odds in their favor when it comes to trading and investing. I will say that I don't think this is for people who are kind of looking to swing for the fences. If you're more like the gambling type who just does this for fun, it's probably not your thing. I think this is something for you if you're serious, if you'd like to actually turn a positive return on a more consistent basis and actually make this something serious, like another source of income. The average millionaire in the United States has 7 sources of income. So, this is really the way we look at this as another source of income for you to learn this. Now, there's a course that comes with this, and you're going to learn a lot of the ins and outs of all this. But what's most important to me is that we teach you how to turn this into a regular income machine, right? And how to diversify this among different sectors and industries. And so the way this works is as following. If you were to get just the course itself, the video course, that's $199. If you wanted to get the ongoing market sessions, which we do every month, we've got 2 of them scheduled this month, like ongoing, like lifetime, that's $497. The indicator itself is $1,997, and we added a priceless new iron condor module. The whole package value here is $2,700 almost. We're going to give the next 50 people a 90% discount, so it's only $297. But that's literally just for the next 50 people, and it's a one-time payment. This is not a recurring fee. This is not a membership. It's not a monthly fee. Well, it's a membership in the sense that you purchase it once and you're a member, right? But it's not a monthly membership. It's not a quarterly membership. It's not an annual. You pay one time, $297, and that's it. You get the income course. You get the ongoing monthly webinars, which I'll talk more about in a minute, and you get the indicator and scanner, of course, which is very, very important, right? So those are all the things that are included with this, but it's only for the next 50 people, and that's 90% off. Now let me talk a little bit about those monthly sessions. The next one, by the way, is May 15th. That's next week. They're always recorded as well. So if you can't join one live, you can of course join watch the recording. So what do we do in those monthly sessions? Number one, in every monthly session, and we have 2 of them scheduled for next month, we give you a trade idea. Okay, so in every session, we give you an actionable trade idea using the indicator along with this. We also teach you exactly how to use the strategy, right? And by the way, you can go to, if you want to get this, you go to thesteadytrader.com/income. It says it here at the bottom of the screen. I should have said that earlier. And it's also typed into the chat box. In each session, we teach you exactly how to use the indicator and scanner. We teach you exactly how to put on the trades. And again, we give you a trade idea, right? It happens every single month. We've got, I think we did 16 or 18 of these sessions last year, and I think we've already done about 10 of them this year. And we've got 2 of them scheduled for the month of May. The next one is May 19th. In terms of option strikes, yeah, so the way this works is there's a formula for how we choose our option strikes. I see this question a bunch here, and that's exactly what we teach you in those live webinars. That's why it's so important to join the webinars. But you don't have to join them live. I mean, they're always recorded as well. So if you come in and you can't make it live, it's very simple. They get emailed to you, and all you have to do is you go to the website. Once you have to log in, you click on TST Vertical X Pro, and then from there, you choose your platform. So if, like, for me, it's Thinkorswim, and then you just go ahead and you watch the video. We have a team that can help you install it as well, so that's easy. And the past recording of the webinars are here as well. So it's everything's there. And again, this is a one-time payment, and you're a member for life. We have people that have been in this for years and years and years. They come back every month for the webinar. They get the free trade idea. They learn more about how to use the strategy and how to use the indicator, and they move on. And that's really my goal, is to make sure it works in any market. I mean, so if you trade futures, Chuma, or if you trade really anything, the indicator itself works on all markets. We like to do credit spreads using the indicator. Does that make sense? If you want to do day trading with this, by all means, install the indicator and use it for day trading. That's certainly fine. We use it for credit spreads. So when we do the webinars each month, the webinars are focused on the trade ideas. We give you our swing trades. So this is Amazon, for example, intraday today. I'm not making this up. This is where it was overbought this morning, and that's what's happening so far. Let's see here. Other questions? Let me make sure I know if we're going to wrap it up here in just a minute, but I want to make sure we get all the questions answered. Yeah, the next webinar is May 15th. So if you're getting this right now, what I would encourage you to do is take your time, maybe watch the video that came with this. There's a course video that came with it. You can watch that. but don't freak about installing the indicator, right? You can send us an email that supports them. If you have problem installing, they will do a remote PC with you if you have trouble there. We have beautiful videos that can help you install it. So it's really easy, the whole thing. But to me, what's important is that you join the webinars and really make an effort to actually learn how the strategy works. We give you a trade idea as well in every single session. Again, we do 2 of them next month alone. So there should be plenty to do. You can install the indicator on, let me go back to this. You can install the indicator on the following. One second, I should have mentioned this again before. You can install the indicator on Thinkorswim, TradeStation, NinjaTrader, or TradingView.com. Those are the ones. So if you don't have any of these, go to TradingView.com. And again, there's a video how to install that, and we can help you with that as well. So that's easy. Yeah, the day trades print, as I just showed you a second ago, that's exactly how it works. Cool. All right, guys, listen, I'm going to pass it back to Jeanette and Raleigh. Thank you so much for putting on the show here. Much appreciated.
You're welcome, Serge.
Oh, by the way, I should have showed my mug. Here, let me put on the video.
Show it.
Hey, there you are.
I'm actually in my office, you see? It's an actual office.